Take it away, Rick.
Well, good afternoon, everyone. I want to thank you again for joining us for another session with Alan Gassman and company. And this week's session is going to be running the numbers on estate tax planning strategies. And we want to thank Alan for really being part of the Kettering Health family of supporters in getting out the best and brightest among those in the industry regarding estate planning. And really want to thank him for all the work he's done with us as we in our community look to engage our donors and our constituents with the best information possible so they can make informed decisions not only about their personal life, but about what they're doing charitably in support of Kettering Health. Kettering Health Foundation, which I lead, is the philanthropic arm for the Kettering Health Care System here in Dayton, Ohio. And so if you'd like to go online to ketteringhealth.org to find more about us, you can do that. But this time, I'll just have Alan to take it away with Jill and Joey. Thanks so much, Alan. Appreciate it.
Thank you very much. And I am here today with Jill Ashley, who is an experienced CPA and financial advisor. She just has bad judgment because she decided to get a law degree, and she's going to Stetson Law School and doing very well there. And then Joey Kleiner, who has a background in financial work and is also pursuing a law degree, and wonderfully is a computer programmer as well. So we've been having a lot of fun so far this summer, ramping up the Estate View software that I've had as a hobby for quite a bit of time here. And you can see this, and we're recording it so you can see it later. But I also want you to know that if you're attending this Kettering presentation today on June 15th, 2023, you have a free 1-year subscription to the software as it now stands. Initially, you're going to be a beta tester, and then during the year, hopefully, we'll actually go commercial with it. And it's really easy to use. Go to Estate View, ESTATEVIEW.link, as you see there on the top left of my screen. And then the top secret email address for you is test, T-E-S-T, at test, T-E-S-T.com. And then the top secret password that is for you and only you, don't tell anyone, but it is the word test, T-E-S-T. I hope you like our special effects. So I designed this initially to help show clients how the estate tax works. And I'm going to take you through just some parts of the software, primarily because of the illustration function. So what I have here, and it's very easy to use. And by the way, it is web-based, but it only has the information specific to your clients on your computer. But if you want to make double sure, just use fake names. You don't have to use your client's actual name. And this will work on an iPad. It will work on a PC. It will even work on your phone. Now, your IT people may need to let it through, and we're glad to give them any information they need in order to do that. But what I have here is a client's name, and you can put in the date of birth or the age. And if this client is 70, but if I want this client to be 65, I can just scroll down or type in 65. This client is male, non-tobacco user. So the computer is telling me that the actuarial tables say that there's a 50% chance that this person will die in 2038 and a 50% chance that they'll die after 2038, or at least 50% they'll die before 2038, a 65-year-old. Now, if they were a smoker, I can click there and see that they would be expected to die in 2036. Then I can set the date of death for whatever I want. Here we're showing a date of death of 2029. I like to show a date of death of 10 years just to keep things in the decimal system. And then they haven't used any of their lifetime exemption, and they're going to actually spend their Social Security plus $100,000 a year more than they earn or until reaching age 80. And at age 80, then we expect the spending will go down to $75,000 a year until for the rest of his life. His wife is creatively named Mary. She is 60 years old. She will die, let's just say, in 25 years, and neither of them have used their lifetime exclusions whatsoever. The estate tax rate here in Florida and most of the country is 40%. We don't track the state estate tax rate, but if you're in a state that has a 5% estate tax rate, you could just estimate it by clicking up to 45%. But I'll just keep it at 40 to keep things simple. And then change CPI, which is what the exemption amount goes up by every year. We'll just guess that it's 3.71%. We'll guess that real inflation will be 5% or maybe 4.75%. And then the portability option. If he dies, will she get that portability allowance that he will not use? And we'll assume that, yeah, she'll get that portability allowance, which I'll explain in a little while. Will the exemption amount, which is now $12,920,000, going up with chained inflation, will it drop to half in 2026? Well, let's initially say no. Joey, Jill, anything I've missed so far as describing what I've covered?
I think you've got it all. Joey, do you see anything?
Nope. Okay, good. So now let's put them in I don't want their house to be worth more than my house. My gosh. So let's just put them in $1 million house. And houses don't appreciate as much as the stock market historically. So I'll just let their house appreciate at 3.78% and assume that the recent years have been an aberration. And then they have a business and investment assets. And maybe we'll just say that those are worth $20 million. And that they'll grow at 7.5%, but their investment costs will be 0.5% a year, and their taxes as a percentage of the entire portfolio, let's say, will be 1% a year. And then I want to know what's the most that can go into a credit shelter trust when John dies with the inflation factor on his exemption. Well, the most that could be would be $18,590,000. And they have 3 children, and they expect that in 9 years, suddenly they'll have 3 grandchildren, just to run numbers on their annual gifting. And all of their gifting will be into an irrevocable trust because their children and grandchildren will be magically self-supporting. Good luck with that. So taking it that far, what do you think that this married couple would need as far as their estate tax planning is concerned? They're under the 26 million, and most clients who are under the 26 million, if they don't accept the exemption to go down to half, they're not that worried about it. And you can even see here, and here I'm going to click on the top right hand side, current estate, no planning. And sure enough, they really don't have much to worry about. There's the residence at $1 million. There's the investments at 20 million. You take 100,000 out, you grow it by 7.5%, minus 0.5%, minus 1%. They're at 21 million, and they have exclusion to spare. Their total exclusion, 26,780,000 if they both die together. Their investments, 22 million. Their assets, 22 million, 0 estate tax. And then they've got the portability allowance. So if one of them dies, no problem. But let's say they do no planning. I click here, and they will have the portability allowance. So on John's death, everything goes to Mary. And then on Mary's death, there's an estate tax. Can you guess, Joey, give me a guess of what you think the estate tax will be? And you only have 1 second to guess this. What do you think the estate tax will be after 25 years on the second death?
I'm going to say it's staying at 0.
0, okay. Jill, any guess?
Say more than 10 million.
Okay, more than 10 million. I'm going to say 40 million. So I'm going to click here, no planning, and I was wrong. It's only 14 million. That shouldn't bother them at all, right? Because here you see the rule of 72 with a net rate of return of about 5.5% after 10 years. Your assets are worth about 36 million. And then another 15 years, she's at 82 million. Fortunately, with the portability allowance and her exemption, she's got a 50 million there. So the estate tax is a paltry $14 million. Now they say, what about if John dies and Mary remarries and her new spouse is fabulously wealthy? So when he dies, he leaves his exemption amount to his children. And then what would that do to her estate tax? So I click here for no portability, and that estate tax goes from 14 million. I'm going to guess that it's going to go to 24 million. Jill, what's your guess?
I was going to say 20.
Okay. Well, I'll click there, 21 million. So I won that one. So no portability, the difference in portability versus no portability, $7 million. So are you going to rely on portability? I'm not going to rely on portability. I'm going to use a credit shelter trust. Now, the other question is, the exemption could go down to half. If the exemption goes down to half, I'll click here. That estate tax is back to 24 million. And if you lose the portability allowance and the exemption drops to half, then the estate tax is 28 million. So you have to decide which of these you want to use. So what's next? Well, I'm going to do a credit shelter trust, as I said. So how much credit shelter trust can I do? If he dies first, there's only going to be 35 million of assets. And this will tell me my maximum credit shelter trust, as I page up here, is going to be quite a bit, 18,590,000, but that assumes that the assets are all going to be pushed the right way. Now, what do you think the credit shelter trust is going to save me, Joey, when I click credit shelter trust?
I'm going to say it's going to go down by 4 million to be at a nice 10.
10 million. And it went down to 3,500,000. And one of the reasons that I'm asking Jill and Joey these questions is because I'm showing you these are both accomplished financial professionals, and they've been working with this software, as have I. And your gut feeling on the results of planning techniques are not always right. It's hard to guess this stuff. So explaining to a client that they have a serious estate tax problem is a serious conversation to have. But I'm glad that in this situation, starting with 20 million, they can pass quite a bit estate tax free by funding that credit shelter trust on the first death. Now, what about annual gifting? I showed you that they have 3 children, so that's 6 gifting powers during their joint lifetime, and 3 after, presently at 17,000 a year. So I clicked on gifting, and the state tax goes down to 0. That's pretty darn lovely, because that little gift for those 3 children after 10 years is worth $3.3 million. That's the value of annual gifting. So you know what? We got to increase their net worth. We need a more challenging situation here. So I'm going to give you a more challenging situation. And this couple is worth 30 million. There you go. And 30 million plus the house. We should give them a nicer house too. You know, if you got 30 million of investment, you should at least have a $2 million house. That's at least half the size of Rick Fee's house. So let's look at this, and also let's also say that they own an S corporation, and that S corporation, that S corporation pays them $300,000 a year. So they break even, plus the S corporation gives them $300,000 a year. So what's their situation? Well, with no planning, they're at a $35 million estate tax. The estate tax is more than their present net worth. That's always fun. With a credit shelter trust, they go down to 24 million. And then with annual gifting, they're down to 19 million. So let's bring out the big guns here. And the first big gun is you could do discounted annual gifting. So you could put assets in a limited liability company, transfer non-voting member interests in that limited liability company. And I'm going to go to here to the gift trust module. And I'm going to assume that they're going to do this for these number of years, and that they're going to take a 30% discount on the value of what they're giving. So they're really giving more. So I click here, and when I click here, the gift trust goes from 14 million on the second death to 19 million. So that's a $5 million savings just for setting up an LLC and transferring LLC interests every year. How much work is that? The main part of the work, as you know, the actual doing the documents and having them sign that is what, $1,000 of work every year once it's set up. Getting the client to do it, priceless. Good luck getting them to do it. But maybe if you show them that it will save those beautiful grandchildren $1 million, they'll be a little bit more likely to let you do that, because you have 14 million there without doing that planning, and 19 million if you do, passing estate tax free. And half of that could go into a spousal limited access trust that could benefit the surviving spouse. But then, of course, the client says, what else can you do for me? And one thing that might be possible would be that the client could buy some life insurance. Right now, I'm showing no life insurance. So I will just I will set up a policy, not in a life insurance trust. Let's say the client comes to you and they have a permanent policy, and they're going to pay for the next 10 years, $5,000 a year. And then after that, for the next 6 years after that, they're going to pay $11,000 a year. And it is going to give them a death benefit of $400,000 during the first 10 years. And if they die after the 10th year, it's going to be $475,000. Now, that's more complicated than you need, but it just shows you what we can do. So that is what they have now. And what I can do is copy that. So now this is before. So they walk into your office with what you see there. And then I can go with an after by adding, where did I do that? Okay, I can go there, click held in life insurance trust after. Let's see if I'm doing this right. So anyway, now I click on life insurance planning, and you can get a different answer. And the net estate tax went up because I'm showing it outside of the life insurance trust. So I'm going to go to the next module now. And by the way, this will, you can add infinite policies. You could have 100 policies. You could have term policies. You can have permanent policies, or you can remove policies just by hitting the red box. If you don't like life insurance, you don't have to have it. Okay. The next, and you can have a policy on each spouse, one on a second to die. The next one is an installment sale. So now, even with life insurance planning, I'm an estate tax of 18 million. So here's what I want to do. I'm gonna, let's just say that that the client is willing to put $10 million into an LLC. So I'm gonna put this at 10 million, and 99% of the LLC is worth 7 million if you assume a 30% discount. And the applicable federal rate for a long-term note right now is about 3.69%, but let's say it'll be 3.75%. And the note will not be self-canceling. It will be conventional, and it will be a 20-year note. And what will happen here is the client will put $700,000 as a seed capital gift, cash or equivalent assets, into an irrevocable trust. The trust will be disregarded for federal income tax purposes. He'll put $10 million worth of assets into a LLC, and assuming a 30% discount rate, will sell the 99% non-voting member interest in the LLC for a $7 million note, bearing interest at 3.75%. So you got, now this is a very good illustration, our illustration software. Ding, ding, ding. This is the client. Ding, ding, ding. This is the trust. The client puts the assets into the trust and then sells the LLC interest to the trust. And now all these years go by, the note gets paid, and when I click here, Joey, what do you think the estate tax will be based on this $10 million maneuver?
I think it's definitely going down. I've not been too good at these guesses this morning, so I'm gonna go with 11 and hope that's a little closer.
All right, I'm gonna go with 5. Jill, you got a guess?
I'm gonna go in between.
Okay, all right, always hedging. All right, so I click there, and it went down to 9,581,000. So that little $10 million maneuver saved $9 million of taxes. So then my next question, of course, is, well, how much does the installment sale need to be for us to zero out the taxes? Because I have $18 million worth of investments. These clients could do a very large installment sale. Well, all I have to do is click up here. When I click up here, all the numbers move. Like when it goes to 10,000,005, your seed capital gift at a 10% seed capital gift would be 735. Your estate tax is going down. I mean, and then you see the investments go down here as I'm clicking down, and you see the installment sale going up. Now, we have another way to view this, and that is I'm here in the trust logistics section. I can go to timeline. So I don't want to hurt your eyes. So let me go back to these people with a bypass trust, a lot of estate tax, and the client says, well, when does this happen? I see year 10, I see year 25. What happens in between those years? Well, I can click timeline, and now you see that initially they have all these assets in green and a lot of estate tax if they both die. This tells you what the estate tax is on the second death if they die before 2048. You can see here, and you see that in 10 years you get a credit shelter trust here, and the gift trust is ever increasing. But the estate tax, this is the portion of the assets that go to the estate tax. Now at this point I could say, well, what if you die earlier? I can just move the first death back, or I can move the first death forward. That's neat. And then I can say, well, what does annual gifting look like? There's annual gifting in blue. What does discounted gifting look like? A little better. What does life insurance look like? There's that little life insurance trust. And what does an installment sale look like? That nice, pretty yellow. And now I can click up the installment sale to the maximum amount to try to get that estate tax to go away. So that is the big picture on the program, that this part A of the program. That it will also tell you your annual amounts for each item. So if you want to just check the math, this is how we got to what the annual savings is. Now there's something I forgot to do, and until you get this thing right, there's one thing I forgot to do. Let me go back to logistics, and that is, and I'll hit full fit. But the one thing I forgot to do was I forgot to tell the computer that we're selling S Corporation stock that I said is generating $300,000 a year. So when that $300,000 a year goes under the installment sale trust, it comes out of their annual addition. So their annual additions went from positive to negative, and now the estate tax savings does bring the estate tax to 0. So we really would like your input on this. We want you to use it so that we can make it better than it is now. Another feature, just so you're aware of it, is that it will generate a letter to the client. So I will click here, and then I'll select all scenarios, and I just want the main charts. So I click Generate Client Letter, and the computer is now generating a letter to the client, and we're still building out the letter. Jill's been working on the letter. We may even have a simplified version of the letter and a more complicated version of the letter. But in any event, the letter just came out. It comes out as a Word document. If any of you also happen to use WordPerfect, let me know. If I wasn't the only WordPerfect user in the United States, I would have it come out in WordPerfect. But here is the letter. So what's nice about the letter really is that it stores all the inputs. You can store the inputs on your computer, but the letter will summarize them. And then the letter will also then show them each scenario, and it shows them what the tax savings will be from the use of each of those strategies. And Josh will be sending a copy of this letter to all the attendees, whether they want it or not. All right, so Jill, Joey, any suggestions on anything else I should mention at this point before we go? Yeah, that's a great idea. I forgot all about those. All right, so I go here to calculators, and we have 5 calculators or 6 calculators today. Kevin Gray, our amazing programmer, promises us a new calculator by the end of this week, which is going to be for charitable remainder trusts. But the calculators we have are the installment sale calculator, which I may show you next month, a qualified personal residence trust calculator, a grant or retained annuity trust calculator, a skin calculator for self-canceling installment note, a charitable lead annuity trust calculator, and a private annuity calculator. So because this is for the Kettering system, and because clients don't like to pay federal estate tax, I'm going to make sure I show you first the charitable lead annuity trust calculator. Drum roll, here it goes. Hold on to your seats. And there it is. Pretty exciting, huh? So a charitable lead annuity trust, or Jill, Joey, do either of you care to tell us what a charitable lead annuity trust is and how it works?
So it was popularized by Jackie Kennedy Onassis, who used that as a testamentary charitable lead trust. They can be set up as either lifetime, they can be grantor, non-grantor, or testamentary at death, and can be used to actually wipe out estate tax if you use it properly, at death. It works opposite of a charitable remainder trust, where the charity receives a stream of payments for a term of years, and then the balance, the remainder goes to family beneficiaries at the end. It's gift and estate tax free going in. If it's a grantor type trust, it's disregarded for income tax purposes. So the grantor gets a income tax deduction for the charitable contribution for the full amount going into the trust at the beginning. And generally, even though you have actuarially on the calculator, you have it calculate a charitable deduction and remainder interest, it grows significantly over time, and therefore the beneficiaries get, usually a large amount at the end.
That was really good. Josh, what are we doing with sound here? We got feedback somehow, Josh? Josh! Can you go get Josh, please? Sorry, I got feedback here. Anyway, what you see here is a June 15. Well, no, I hear feedback. Ladies and gentlemen, we apologize for the feedback. The problem is not in the station. The problem is in your personal computer. I think it stopped. Okay. All right. So anyway, a charitable late annuity trust, what you do is you tell the computer what the 75/20 rate is, and the computer automatically knows that it's 4.2% as of today. We call that the hurdle rate. Things work very well if the rate of return earned by this vehicle is more than 4.2%. If it's less than 4.2%, there's nothing left after the charity payments. You can tell it the grantor's age, but that really doesn't change the calculations I'm about to show you. And then the term of the charitable lead annuity trust, let me show you a 15-year term. And what this is telling you is that if you want a charitable lead annuity trust where you make a transfer to the trust and it's considered to be 100% charitable on the day of the transfer, even though significant assets may pass to non-charities at the end of the CLAT term. Here's the numbers. 15 years, $1 million goes into the CLAT, 75/20 rate, 4.2%, gift value 3 cents. We could make the payment a tiny bit lower to get that down to zero. The annuity payment, $91,203 a year. So I put $1 million into the CLAT. I get $1 million charitable deduction. The CLAT pays my favorite charity, which starts with the letter K and ends with the word Hospital Foundation, $91,203 a year. And when you look at the assets growing at 7% a year, what's left that comes back to me or my descendants at the end of the 15th year is $467,000. So think about that. I may save $37,000 of income taxes. I get credit for donating $1 million, and I get $467,000 back. Or if I want to avoid estate tax, the $467,000 can go to a trust to pay distributions as needed for my spouse and then to my descendants. So that is what's so cool about a CLAT. But something more you should know about a CLAT is the payments do not have to be level. So, by the way, when you go to somebody and you go, could I level with you, Jill? I just want to level. And then when they say, sure, you can level with me, pull out your level and hand it to them, and you have one and say, well, let's level together. Okay. Anyway, going back to the payments, I showed you level payments and it looks pretty good, doesn't it? It's a great result, but let me show you, I go back to payments. You could increase the payments by 20 a year, 20% a year. As an example, it's super safe to do this because you could do it with grantor retained annuity trust as well. So everybody feels comfortable with 20%. So I click on that. So my initial payment is only $21,000, ramps up to $277,000, and I have just learned something very important. The remainder interest goes up by $200,000 when I increase that payment by 20% a year. So now I get $1 million tax deduction. I get $656,000 back in 15 years. Not a bad deal. Joey, you've listened to this explanation. Would you have anything to add or to say in addition to what I've been saying here?
Yeah, I saw when you switch the payment terms there's also a shark fin option. I think that would be really cool to look at. And then I think there's some charts that might help visualize what's going on here as well.
Okay, so let's go to shark fin. Now, what is a shark fin? And this has nothing to do with the important song, Baby Shark, do, 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 Baby Shark. So I hope you don't sing that song to yourself for the rest of the day. But anyway, with the shark fin clat, do, 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 Baby Shark fin clat, the payments start low and then they go way up at the end, just like a shark fin. That's why they call it a shark fin clat. So look here, with level payments, you get $467,000 after 15 years. With increasing 20% a year, you get $656,000 after 15 years. But if I click on shark fin, and Jonathan Blotmacher told me that you can't pay zero, pay something. So if I pay 1%, or I pay, I pay 1% a year for the first 14 years. And then at the end of the 14th year, I pay, look at that, 868 million, then, I mean, 868,000. So starting the annuity at 5%, that, I meant to put that at 1%, I'm sorry. Operator error. Okay, so I click that down to 1%, and now 10,000 a year to charity, and at the end of the day, charity gets a final amount of $1,641,000, and my children or I get $875,000 estate and gift tax free. So that is the shark fin clat. But wait, it gets better. So here I was, this is basic. And some of you are saying that maybe like basic marine training, not so basic. This stuff is complicated, but we're going to get even a little bit more complicated by clicking on advanced. So hold on, put your sunglasses on. This is going to be, we need like theme music or something. But I click advanced. And now, what if the client is going to live until year 30, for example, or year 24, and I'm still doing a 15% clat. So, but instead of donating stocks to the clat, I'm going to put the stocks in an LLC, and I'm going to transfer the 99% ownership in the LLC. So I'm going to show a discount rate of 20%, a very, very conservative discount, and it does need to be conservative if the LLC is going to fund the clat payments. Maybe we just go 15%. So I'm telling the clat, I'm telling the calculation mechanism that I'm only putting in $850, and therefore my payments only have to be $8,500 a year, and a final payment of $1,395,000 with the remainder interest. Is this true? 2 million. So how does this work? Oh my gosh. So it starts with $1 million. It grows by 70,000. It makes a payment of $8,500. And after 15 years, it pays the final payment of $1.4 million to charity, leaving for me or my children $1.158 million. So the charity ends up getting, what is that, about 60%? And my family gets about 40%. That's a great, great deal for my family. That's a lot better than giving 40% to Uncle Sam. And if I do this during my lifetime, hooray, I get an income tax deduction. But what if my family can wait 20 years? So you see here, annuity amount. If I click this, the term of the CLAT, 20 years, then the charity gets $1.6 million, my family gets $1.8 million. And you could take a CLAT as long as you want. You could go 25 years. And look at that. The charity gets $1.9 million plus the $8,500 a year, and the family gets $2.8 million. So you could get this to where instead of paying Uncle Sam 40%, you pay charity 40%. And your children wait 25 years, which for many families would actually be a very good thing. So Joey, do you want to walk us through some of these chart features here? Do you recall what these are? Besides the fact that they show how brilliant Kevin is, we do have some charts.
Sure. So this first one is a really good way to visualize the different payment terms. So we talked a little bit about doing the level payments and then the increasing payments and the shark fin payments. So on this one, it looks like you had it there.
Oops, sorry.
That's fine. It looks like you had it there. You might need to refresh here. Get that.
There we go.
There it is. So you can see that little shark fin at the end pop up as that big payment comes in at the end. But if you go ahead and switch the payment terms back to level, you'll see that annuity amount, consistent throughout the years, but it really doesn't give charity that same large payment in one year for them to make a major expense the same way that shark fin would, while also benefiting you and your beneficiaries. So I think it's a good way to visualize that difference between the payment terms. The next one's that probability of survival by age. So this is just a quick way at a glance to understand how likely it is that the grantor will survive the trust. And then that last one, the trust value over time, is a way to visualize, what happens inside the trust and see that growth.
Wow. Now, I'll just mention that I can also click duplicate. And when I click duplicate, it shows me a second CLAT. And the second CLAT it shows me is exactly the same as the first CLAT, except I can change that. And then I have two different CLATs to look at. So when I go back to tables, I have CLAT 1 and CLAT 2. So I just change a couple things. Maybe I'd make it a 20-year CLAT instead of or an 18-year CLAT instead of a 20-year CLAT. So CLAT 1 is showing you an 18-year CLAT. CLAT 2 is showing you a 20-year CLAT. And then I could do separate charts and compare them. And we'll be improving the program to make the comparison between them side by side instead of one underneath the other. So I have 17 minutes. And Josh, will you be able to print out the questions if we have questions at the end? But anyway, let me show you one more calculator. And I'm going to show you the self-canceling installment note calculator. And then next month, we can go over the CUPERT, the GRAT, and private annuities. But the self-canceling installment note calculator is here. And as you can see, it's the same type of format as you just saw with the charitable lead annuity trust. Now, the self-canceling installment note is a wonderful thing for a client who would like to get a higher interest rate on a note owed to the client and would like for the note to go away on death. And while the IRS argues that you cannot use the standard mortality tables for a self-canceling installment note. They may well be wrong. So if a client doesn't have great health, you might consider having a promissory note owed to the client or an installment sale note be a higher interest rate. And in exchange for that, the note vanishes on death. So I can use this module to determine the exact installment sale specifics that I want in the first module that we saw, or I can demonstrate it here alone. So we know the 75/20 rate is 4.2%. The computer tells us that. We'll say that the client is age 65, and we're only going to use one life here, but you can use two life, and you do remember the TV show One Life to Live. There's now two lives to live. Now, it also automatically tells me that this 65-year-old's life expectancy on the 210 CM table is 19.1 years. So I can safely use 19 years as the term of my self-canceling installment note, and that is what I'm going to do here, just to show you, because that is what would normally be done. So what do you have here? I've got a 19-year note, 75/20 rate, 4.2%, applicable federal rate, 3.69%. Now, I'm going to use an interest rate premium, and it tells me that for a 65-year-old, that interest rate premium is 3.28%. So the total interest rate on this note is 6.97%. So if this client, in actuality, has a life expectancy of 5 or 6 years, I believe that you can use a self-canceling installment note, and when the person dies, the note cancels. So here's what Kevin tells us in the spreadsheet. And by the way, all these spreadsheets are exportable to Excel. You just click there and it becomes an Excel document. So here I've got the client's age. I've got $1 million starting with. It grows at 7%, pays him $69,676. In value stays at just about $1 million. That is a coincidence. And then when the client dies, and here's the chance of the client dying each year, when the client dies, the note will go away. So the estate tax savings when the client dies will be a significant amount. Now here we have the client dying in, I believe, year 20, so the note doesn't cancel. But if the note goes beyond when the client dies, then the note would cancel. The estate tax savings are significantly more. And then if you're doing this as an installment sale to a trust, you can put in a seed capital gift. So that generally explains it. Now, there's two different things you can gross up with a self-canceling installment note. You can gross up the interest, and on a 20-year term, the interest gross up is 3.39, or you can gross up the principal. So I go here to premium type principal, and instead of $1 million note, or I give a note that is much higher. You got to increase the note by $1.6 million if you're going to be increasing the principal. But so there you see on the first year that note, instead of $1 million, is $1.6 million. And you also see the estate tax savings based upon the year that the client dies. The other thing we have here, the other feature, is when I click advanced, and by the way, I can do multiple skins, so I could add another skin and to compare it to the prior skin. But when I hit advanced, I can also show discounting as a strategy. So if I put, instead of $1 million, I'm going to put $1 million in an LLC. I'm going to take a 20% discount. So the self-canceling installment note is lower, and what's left in the trust at the end of the day is much higher. So and then of course here you see both the first one I did and the second one, and I could have as many as I want. I could have 1 million of them if you just click 1 million times. So Jill and Joey, I don't feel like I did a great job explaining all that.
I can add to that.
Please do.
Yeah, and when I turn on my microphone is when I get the feedback. But I just think, in case everybody doesn't know, the reason for the premium has to be either added to the interest rate or the principal. That is the trade-off for having the note cancel and not be counted as a gift. So I think, you know, you would go through the scenarios to see which payment schedule works best with the life expectancy, the actual life expectancy compared to the mortality tables. And then if the interest rate turns out, it calculates to be, you know, a very high rate or usurious, then instead you would go ahead and increase the premium to the principal instead. So I think that's the purpose of the trade-off for not including it in your estate, or not, you know, the cancel part, assuming that the grantor dies during, or the grantor dies during the term.
All right, and Joey, anything to add?
No, I
You're
think that
muted.
about covers it.
I think you're muted, Joey. Oh, no, you're not. I'm sorry. Go ahead, Joey. Start over.
That's fine. I was just saying I think you guys about covered it there.
Okay. All right. Super. All right. So let me just mention, if you're a neophyte to this area, if you use what's called a private annuity instead of an installment sale, and I'll go here to the private annuity calculator, which we can cover next week, you can use the standard life expectancy table, which is now table 2010 CM. Even if the person has a short life expectancy, as long as they have better than a 50% chance of not dying from any particular identified condition at the time of entering into the arrangement. So the client comes to you and says, I just got some really bad news. I have a 50% chance of living 13 months from kidney disease, a 50% chance of living 13 months from heart disease, and a 15% chance of living 13 months from a lung disease. My actual life expectancy is 7 months. Well, you can use that 13-month expectancy as to each disease without having to worry about the cumulative effect of the 3 diseases. In addition, if the client lives 18 months after you have set this up as a private annuity, then the service has to accept that there was a 50% chance of living a year unless they have clear and convincing evidence to the contrary. So when a client comes in and does estate planning, if you can remember to say, if you ever have a bad diagnosis, call your spouse first, me second, because bad news can be good news. And for example, a common diagnosis, unfortunately, is lung cancer, may have a 2-year life expectancy. That is perfect for a private annuity. Many of us believe that a self-canceling installment note is a private annuity, because a private annuity, while typically you would arrange it as an equal annual lifetime payment, you don't have to. You could shape a private annuity any way you want, basically. In fact, in the kite case, the famous kite case, Mrs. Kite's private annuity made 0 payments for the first 10 years, and she died in year 2 or 3, I believe. And the tax court said, that's fine. It was a private annuity. Well, if a promissory note is based upon the same exact calculations of a private annuity, isn't that just a private annuity? There's differences, and I'll be glad to send you the white paper we're working on, but I'll go ahead and show you the private annuity here. I know you're just dying to see it. So, oops, that's not a good thing to say. Anyway, but maybe the family is looking forward to seeing it. You put $1 million in the trust. The 75/20 rate is 4.2%. You are age 70. The annuity amount is $94,000 a year. What's left in the trust after the years we're showing here, after 16 years, is still $230,000 if you don't die. But if you do die, the whole million is out of your estate. So it definitely cheers up the funeral, that's for sure. Now, there is something, unfortunately, called the exhaustion test, and it's exhausting to even describe it. But the IRS says that if you make this sale to an irrevocable trust, which we most often do to keep it income tax free, then the trust has to have enough in assets to pay the annuity until the annuitant reaches age 110, based upon the assumption that the assets grow at the 75/20 rate of 4.2%. So in order for me to do this $1 million private annuity for a 70-year-old, I have to have $1,824,000 in the trust to begin with. But a lot of clients have a lot in trust. There's also a number of commentators who have questioned whether the exhaustion test is even valid. Number one is a regulatory issue when you read the issues, but number two, it's arbitrary and capricious to me to require 110-year survival when the chances of a 100-year-old living to 110 is like 1 in 100,000. So just to mention, you can do a 2-life skin, you could do a 2-life private annuity, and the private annuity annual distributions, if you go to advanced, can be, of course, what you put into the private annuity can be discounted. The number of years you want to show, you can move there. And then the payment type of a private annuity, if you don't want to go level annually, you could increase by 20% a year. And in future iterations, we'll have a shark fin private annuity and other ways to adjust that private annuity. Going back to the skin, I showed you a 65-year-old grantor. Just want to show you that if his age goes up, the premium goes up. And then you could do a 2-year skin. So second life right now 0, but if he has a 65-year-old spouse, and I click to 65, now you see the numbers that the risk premium goes down and the skin doesn't vanish until they both die. So my partner Ken Crotty and I talked today to a client who wants to get as much as possible out of a trust that he set up for his children, and the trust owes him $1 million. Well, as a fiduciary matter, I don't think they can go up above about 8%. So if I pretend that the 75/20 rate is 8% here, and I show the clients at their ages and they're both 65, then it looks like we can charge a lot more than oh, I've got to go to interest rate. Sorry about that. Need to go up to the premium type interest. So this client, we could charge 8.7%, which will make it a self-canceling note. They both need the money. So, but we'll, the AFR is 3.68 plus the premium is 5.5. I'll take 5.5 plus the 3, about 8. Joey and Jill will have to talk about that. I just massacred the end of this presentation and got all confused and didn't go to the right place. Shame on me. All right, so Josh, were there any questions at all?
I can see them here. There's a couple questions. I can read them out to you if you'd like.
Yeah, please, that'd be great. You could even
Sure.
answer them if you like.
Oh, that'd be even better. So the first one is if the CLAT calculator distinguishes between grantor and non-grantor CLATs.
And the answer is we don't do that yet.
Right,
Call
so
us
that'll
in a
be
couple of years.
perfect. The next one is about whether you can factor in the trust administration costs when you're calculating the taxes due.
And the answer is we don't have that either, but Jill wants us to add it.
Perfect. And then the last one here is more of a substantive question. It's for a CLAT. Does it have to be funded before the death to keep the assets out of the estate?
No, and that's the wonderful thing. And I'll be glad to send anyone the language that we use, but basically the language says if a beneficiary of a trust established on my death wishes to not have estate tax apportioned against her share, she can ask the trustee to disclaim the share, and the portion of the share disclaimed will go to a zeroed out CLAT. And therefore, she will not have her share reduced by estate tax, and the portion that goes to the CLAT will pay to the Pinellas County Foundation or the Kettering Health System for 15 years, followed by whatever comes out. So it's called a testamentary disclaimer to CLAT. And then in the CLAT, it also says, but if the trustee of the CLAT also disclaims, then it will just go directly to the Kettering Health System so that Rick Fee can buy even a bigger house. So, Jill, any final words of wisdom as I mute myself so we don't get squealing?
Yeah, I think just to expand on that or add a little color to it, a lot of people, if they have very large estates, the final remainder amount, assuming it's going to be, already in excess of their exemption or they've already used it, then they will use that CLAT at the end to absorb all the rest that would have gone to estate taxes and allow that to go to charity or charity for a term of years, and then some remainder after some number of years to beneficiaries. So, I mean, I just think it's a great technique.